Finally, I'd like to get your perspective, Barbara, for what you think our tax structure is going to look like going forward, what the ramifications of the things we've talked about as far as the U.S. Balance sheet ballooning. Please give us those insights.
It's safe to assume that the tax savings provisions that are currently in place are probably going to be allowed to expire in 2010 and 2011. Tax rates are scheduled to go up in 2011, and I believe that has to happen in order to pay for the government programs currently in place. And the easiest thing about that is that our current officials can go out next year, which is an election year, and truthfully make the statement that they never voted in a tax increase, that these increases are due to provisions that were put in place years ago. So if future legislation holds the way it should, individual tax rates are scheduled to increase in 2011 from a top rate of 35% up to 39.6%. Capital gains that are currently taxed at 15% will go up to 20%. And the qualified dividend rate of 15% that we're now paying is going to go away, and dividends are going to be taxed at ordinary income rates, which would be the top rate of 39.6%. In addition, we've got the big question surrounding the estate tax. In 2009, we have a $3.5 million exemption and a 45% top estate tax rate. In 2010, we are supposed to have a zero estate tax. And in 2011, we go back to the $1 million exemption and a 55% tax rate. Now, no one believes that we can possibly be at a zero estate tax in 2010, given the fiscal situation that we're in. But we are probably 6 weeks away from when Congress and the Senate clears out of Washington for the year. And what are we going to do about this? Well, the thought is that the easiest way to make this work would be to freeze the 2009 rates, say keep it at 3.5 million, the exemption, keep it at the 45% for 2010. If we just take that and attach that piece onto some bill that's currently going to fly through the Senate and the Congress, something completely unrelated, they can get that in, have it passed for 2010, and then they'll have all of next year to really worry about the details and what they want to make retroactive and what they want to do about 2011. So that's my take on how that's going to work. In addition, while everybody's worried about the IRS, you know that the states have come in and had major overhauls in their budgets, and New York, New Jersey, and Connecticut have all come through with increases in their top individual rates from as much as 1.5% up to over 2%. And that's another hit to individuals. I think today a report just came out of the financially distressed states, and I'm proud to say that my home state of New Jersey made that top list. So everything that I'm talking about, David and Walter have talked about, doesn't even touch on the healthcare issue. The problems that we are facing have not even thought about that number. We know there's going to be a major overhaul in healthcare. The current bill out there is talking about a price tag of $1 trillion over the next 10 years. Everybody's going to be paying a piece of that, and the wealthier people are going to be paying the biggest piece of that. The current bill puts a surtax on individuals making over $500,000, and we'll probably see where that goes, but there will be some tax put on all of us. We also have all mentioned inflation, and whether or not economic inflation occurs, I guess we're not really sure, but when you tack a 10% tax increase on individuals, that acts as a form of inflation because that's 10% less money that you have to spend on anything else that you need. So we know that piece of it is definitely there. So I guess I'll pose this back to you, Dan, and just say that what would we tell our audience as an investor? Here we are, we have a reduced portfolio that we're working with. We have probably a 10% increase in taxes, which means that's 10% less money that we're going to have to invest going forward. We have the same goals that we had 3 years ago that we want to meet, but we're 3 years older and 3 years closer to needing to meet those goals. So I guess we'll be able to give them 3 options with this market, and that's one, save more money, and nobody likes that idea, or take higher investment risks, or some combination of the two.
That's right. That's right. I think some combination of the two is probably where you would fall out. But the purpose of speaking and hearing Walter and Barbara and David speak is we take this information and we help our clients look at their individual portfolios. Because the question sitting in the audience should be, okay, that's all great information. What does it mean to me? So let's tackle the tax one first. Well, if you have a increasing tax rate, one of the things that a portfolio should look at is possibly municipal bonds. Be very careful, though. If you look at the article that we're referencing, there are 10 states on there that are on the precipice of going under, and California and New Jersey happen to be on that list. But that doesn't mean that you shy away from it. Just be more diversified. Don't concentrate on your particular state necessarily for the savings and just state tax. Inflation. I think David had pointed out, and we agree with the sentiment of adding tips to your portfolio and possibly some commodities. Lastly, we have a foreign exchange issue, the dollar dropping, and a proper diversified portfolio that includes a well-balanced international mix, including some emerging markets, will help you defray some of that risk. The point of it is to take the information, work with your advisors to construct an asset allocation that meets with your long-term objectives, meets your risk tolerance and time horizon.